I'm not sure if we can discuss that on this podcast.
Today we have Nitya Adbhutaraja, an experienced mortgage specialist.
Yeah, welcome to NCPL Studio. Which rate does the banks encourage to sell more? Do they encourage fixed rate more or variable rate more?
For 3 years, if they want to have a peace of mind, I would say suggest take the lower fixed rate. Enjoy it till it lasts.
Yes, there are three kinds of customers. The first time home buyer and someone who is already having a home but he wants to upgrade the home. Which a third one is an investor.
Yeah.
Right?
Bank of Canada has a prime rate at 4.95. That's their postal rate. 4.95 minus the 0.35. That's your discount. That discount is going to stay with you forever.
And she has been in the business from the last 15 years.
We used to have a greater discount, but the discount have decreased. And I think it's all to do with the Trump and his tariffs.
I had a very good interaction with her. You will definitely gain a lot of knowledge.
If a person earns 100K,
$400,000. Yes.
provided he doesn't have any liability.
Stay tuned and keep watching this podcast.
Yeah, welcome to NCPL Studio. So we'll have fun talking with you, preferably about mortgages, or if you wanted to talk anything specific, also you can move. The very first question what I was about to ask is like, now we have this interest rates getting increased, decreased, due to which there is a lot of volatility in the market. And on top of that, we have tariffs. So now explain to me like these two, what is the impact of both of these into the mortgage part?
Variable rate, as you know, it have gone up since COVID. Like every time the Bank of Canada decided to increase the prime rate, have gone up, and people's payments have gone up without notice. Some banks keep the payment as is, and some banks increase the payment as per the prime rate increase. So some banks, when they increase it right away when the variable rate goes up, a lot of people have really suffered, and there are people whose payment didn't go up. It stayed as where it is when they signed up for the mortgage, but then now they're collecting arrears payments. They have to pay them off at the time of maturity, or if they want to refinance, they can, if there's an equity in the house, which is really not happening right now, because the house prices are not really moving up, so they're having hard time to refinance to pay that off as well. Fixed rates, on the other hand, it all connected to bond rates, bond yields. So if you are somebody who is on a salary employment, you would like to sleep with a peace of mind at the end of the day, you would want to go for a fixed rate. But fixed rates right now, it's sitting in a good position. Like if you're a first time home buyer, about 3.99. If you're doing refinance, or if you're doing 20% down payment, it's sitting around like a 414, 419 for 30 years amortization. But people are really expecting the prices, the mortgage variable rate will come down. Actually, yesterday they were expecting a
But no
cut.
rate change.
It didn't happen. So still prime is sitting at 4.95, and the discount has it's a very small discount. They're giving about 0.35 if it's a 20% down. If it's a insured deal, then if they're putting less than 20% down, then they get 0.75 off. We used to have a greater discount, but the discount have decreased. And I think it's all to do with Trump and his tariffs. So right now, I think if anybody wants to really, just keep it for 3 years, if they want to have a peace of mind, I would say suggest take the lower fixed rate and, enjoy it till it lasts.
Yes, there are three kinds of customers.
Yeah.
One, someone who is the first time home buyer,
Yeah.
who will take the mortgage,
Yeah.
and someone who is already having a home but he wants to upgrade the home, which means he might go for a top up, or he might get another mortgage,
Yeah.
or change the bank.
Yeah.
A third one is an investor.
Yeah.
Right?
Yeah.
Like for these three people,
Yeah.
like is it that the fixed rate is going to be good for all three of them, or depending on the nature of investment or the nature of the buyer, the rates? What do you suggest for these three types of buyers?
Yeah, it's a good question. So if you are, like I said, like if you're a salary employee and every month this is how much you bring home, then if you go for a fixed rate, you can plan your budget, right? But if you're somebody who's on a rotating terms, you're more like a self-employed, people can take more risk. Then I would say take a variable and see where market goes, right? But a lot of people got burned in the past in the last 3 years by taking a variable. It was keep on going down, and people took that as and when it went up, it was a shocker for a lot of people. So from the past, what I learned is that it's good to go on a fixed rate, and at least till the term is over 3 years or 1 year or 2 year, this is how much you're going to be paying every month, and you can plan your budget. First time home buyers, again, it all depends on their salary or self-employed, on how much risk they want to take. It depends on person to person. So it's really important you tell all your financial planning to your mortgage advisor, and what your plans are in the next few years, so that they can tell you what is best for you. So it depends on the variable and fixed, is all depends on person's income, liabilities, what kind of future plans.
Is it not depending on the market dynamics?
Well, it is. It was a market, but then market also surprised us, right?
Mhm.
Like we didn't know market was going to go this way as well. So market is hard to predict right now.
Which rate does the banks encourage to sell more? Do they encourage fixed rate more or variable rate more?
They literally say know your clients better. Like just
Okay.
know your clients and go according to what fits them.
Mhm.
Yeah, suitability, pretty
Okay.
much. Yeah.
Okay. Many people don't understand, especially because in the market they see, hey, prime is 3.5, but when they go to bank, they see the interest rate is about 6.5, 7.5.
Yeah.
So I don't know what is that difference coming from, where is
Yeah.
it coming from?
Yeah.
What is this stress test and all?
Yeah.
So can you throw some light on these things?
Yeah. Bank of Canada has a prime rate at 4.95. That's their posted rate.
As on June 2025.
Yes.
Okay.
So from there, bank gives you a discount. Let's say they give you a 0.35 discount. Then this discount stays with you till the term is over. So if you're taking a 3-year closed variable or 5-year closed variable, 4.95 minus the 0.35, that's your discount. That discount is going to stay with you forever. So even if 4.95 comes down to 4.75, your discount of 0.35 will stay with you till the term is over. So that's when the mortgage rates, start coming down in your term. I know they hold a key interest rate at 2.75, which has nothing to do with the client's rate when it comes to calculation. But then I know that's where the client get confused. They're like, okay, they say overnight rate hold, key rate hold is 2.75, but then my bank is saying 4.95 minus the discount. So there is a layman language versus the bank's language, right? Or the Bank of Canada's language. But right now, as of June 2025, prime is at 4.95, and then you get whatever discount the bank gives you. The discount stays with you till the term is over. If you take 3 years, 5 years, the term is over.
So there are three components. One is the Bank of Canada prime rate.
Yes.
And another is the whatever banks
charge,
charge, like key rate.
Yeah.
Key rate minus the discount offered by them.
Yes.
So let's say if it is 4.95 is the prime rate plus key
minus
rate.
right now minus. So bank gives you a discount 4.95 minus discount. It's customer's rate.
4.6.
Yeah, minus the
So I
discount.
can get the home for 4.6 rate of interest?
Yes, right now you can do it.
Okay.
Yeah.
So I have seen people offering like 6.5, 7.5.
Those days are gone,
Gone.
but 6 points are there with if you go for B lending, or any. It depends on the scenario. If a client have non-traditional way of getting a mortgage, they are not self-employed for 2 years or some sort of difficulties they have, then there are lenders who would give you a mortgage, but then the interest rate will be a little slightly higher.
Okay.
So those, like right now, our B lenders are doing about 5.3 for 1 year fixed. So the six actually have come down a lot. Maybe a year ago rates were at 6 something, but right now the rates, even the B lender rates, have come down to 5.34ish, which is not bad and there are lenders who could give you even 35 years amortization. Banks stick with 30 years. But most banks, there are a program with even a bank right now, new build is at 35 years. A green program, under a green program, they're offering 35 years. But like a B lenders, they have a program for 35 years. Even we have one of the lenders, they go up to 40 years. Yeah, depends on the situation. But then the interest rate will be slightly higher.
Yeah. And what is this funda about stress test?
So stress test is like, okay, let's say if my fixed rate is about 4.19, that's what the bank is offering me on a 3 years. Stress test is there's always +2 to qualify you. Bank wants to know if the rates were to go 2% higher, can you still manage?
Okay.
So in 2016, the B12, it's called B12, I think 2016 or 2017 December, they brought this in, stress test, just to see if the rate is 4.09, and for example, and at 6.09, can the client still survive? So that's where we qualify the client. If they are getting a rate of 4.09, Bank will qualify you at 6.09 to see if you would qualify under your liabilities and income. So that's pretty much the stress test.
So when the rate of interest by Bank of Canada gets revised, do
Yeah.
they revise the stress test percentage also?
Yeah, whatever rate you get.
Okay.
If Bank of Canada drop downs to 4.95,
Mhm.
and after the discount, if you're getting 4.60, your stress test will be 6.60.
And
So-
who decides the stress test rate?
Stress test rate is any rate plus 2. It's decided by OFC.
So it's always 2.
Any
plus
rate
2.
plus 2.
I see.
OFC
Okay.
have decided this rate.
Okay.
Yeah.
But see this, because I have taken mortgages in India
Yeah.
and in Dubai
Yeah.
and in Canada and also in the US.
Nobody has stress test.
Nobody has stress test, only
Except-
Canada. So
yeah.
why is it so special here?
I believe they have brought down at that time to control the market. We
Okay.
had we don't see much foreign buyers right now.
Mhm.
At that time, we had the books opened up to foreign buyers as well. I think at the time to just control the market, they have brought the stress test. That's probably what Canada did compared to any other country.
Mhm.
Yeah.
Okay, so again, this is especially for the first time home buyers.
Mhm.
Let's most of like people ask me a lot about, so can I buy this, because they have this wrong impression, like, or realtors sell in a wrong way that you're already paying a rent of $2,000. If you buy the same property, you can just pay the EMI
Yeah.
of 2,500.
Yeah, a lot of people make a mistake actually. If you want to buy a house, the first step should be you go see a mortgage person first.
Mhm.
Tell them how much you make, how much liabilities you have, and see how much you can qualify, or how much down payment you have saved up to see how much you qualify for. Sometime I've seen in certain scenarios people do the other way around. They go to the realtor, they buy the house, then they come.
They
It
come.
might be too late.
Yeah.
I always tell the clients, step one, you sit with a mortgage professional, see how much you can qualify. Tell them this is how much I have saved up. This is the car loan I have. These are the monthly payments I have for all the debts I have. This is my income. If you tell them that, they can tell you, okay, you should stay within the budget.
Mhm.
You take that number, then you go find a realtor, then you see houses that fits your budget. And always when you put an offer on a house, I always encourage, take 5-day financial condition. That saves everybody, right? Within that 5 days, we submit all the paperwork to the bank reviews it, and they come back, and we call it condition of finance day. They know when we select there's a 5-day financial condition, bank knows that there's a pressure to work that file within that 5 days. They'll come back and tell us, yes, your client is qualified, these are the condition, or it's a firm approval, or they'll say, you know what, we have issues with this file, sorry, we can do.
Okay.
So that protects the realtor, protects the mortgage person more than anybody protects the client, right? So you don't lose. You hear stories, they lost their deposits because they have done the work the reverse way.
Mhm.
So if you would follow these steps, and you can protect yourself from financial losses and people suing you. And
Okay. And again, for the first time home buyers,
Yeah.
If someone has to buy,
Yeah.
okay, so everybody thinks, oh, I'm earning some 100K, I can easily get a mortgage of so and so. So they do all the wrong planning. But if they have to, they always go by gut. But if they have to do some simple calculation,
Yeah.
even without contacting the
Yeah.
expert,
Yeah.
just to have their own planning,
Yeah.
like what all they have to see, like what is
Just
this?
a rough calculation. If you have no debts,
Hmm.
and you're making $60,000, just do times 4, roughly. That's how much mortgage you can get.
What is that? Times square.
Times 4.
Times 4.
Yes.
Okay.
4 to 5 depends on market and the rates. It used to be 5 when the rates were really low, but right now the rates are sitting at 4. It's 60 times 4. If your income is $60,000, let's say if your income is $50,000, just simply times 4. That's the amount you can
So if
qualify.
the rate is 5%, then times 5.
If the interest rate is like really at like 1 or 2%, then you can do 5.
Okay.
But right now the interest rate is a little high at 4,
Okay.
so you would do 4 times 4 your
Mhm.
income times 4.
So if a person earns 100K,
Yeah.
okay,
$400,000.
so he can get a mortgage of $400,000,
Yes.
provided he doesn't have any liabilities,
Yes.
monthly liabilities.
Yes.
Let's say, so if he has any liabilities, he has to minus those liabilities from the.
We have to deduct them from the total debt ratio.
Yeah.
Yes. And so typically the gross debt ratio, they call it, they take the mortgage payments, property tax, heating, divided by the income. It has to be, typical A banks requires that amount to be at 39. Total debt ratio, they include everything plus the car loans or any kind of loans they have, student loan, car loan, and line of credit debts, credit card debts, that has to be at 44. But if you go for B lending, we can go up to 50-50, 60-60. So we have options as far as the clients, depends on the credit score and all that.
Mhm. Yeah, I'm getting more information. Now
Yeah.
tell me about these. I heard about A lender, B lender, C lender, D lender. What are these?
So
No.
A lender is like, if you are a AAA client, you have a good credit score, you have a great income, you have a great down payment, you can walk into an A bank and they give you, right now the banks are offering great rates, cash incentive, they will maybe waive your appraisal fee, all that can be received from the bank, and banks are very competitive right now.
So A lenders are typically the banks.
A lenders are pretty much the banks.
All banks or the top
All
six?
top 5 banks,
Top.
6 you can say with
Mm.
National Bank too, all top 6 banks. B lenders are like community trust, home trust. There are many, like we have almost including A, B, C, D. Like we have about 265 lenders right now, and they're all again competitive. Let's say you're self-employed. A lot of self-employed people, they don't show all that income they make on their notice of assessment. So when you don't do that, you can really go to an A bank. You can go to a B bank where they use your 12 months of bank statement or 6 months of bank statement. They can average out what you have earned the year and use some percentage of that income towards qualifying your mortgage. So it might be a lot of self-employed people actually benefit from B lenders. The interest rate might be a little higher than A bank, but then it's a peace of mind. You still get like a decent rate. And
so the way they qualify you is a bit different compared to the A lender.
Yes.
Okay.
That's more traditional ways A lender, a little bit on non-traditional ways B lender.
Okay. And what about C?
C's are again, C and D are like private lenders, right?
Okay.
Like they might be institutional lenders, it might be segregated funds, like 4 or 5 people pull together, give privates, or there are many institutions like Opono and all that. They do private lending. There are many private lending out there, but they are also cautious nowadays if they have the equity in the house and all. Yeah.
Okay.
Yeah, and they don't really care about interest. The credit score and all that. They just want to know that you can repay. You have a capability of repaying, and the repayment, they don't look at it like how the banks and the B lender look at it. They just look at it to see maybe they might have a fallback. They might have another house with an equity, so they might do collateral on the other house to lend it. So they are non-traditional way of lending.
I have observed that typically A lenders, like these banks, give the mortgage for 5 years.
Yeah.
Whereas the B lenders, they give it for 3 years or sometimes less than 3 as well. What is the reason behind
So
this?
sometimes the B lenders are used as a short-term vehicle, just to, maybe you have a bruised credit, something happened in the past, your credit got really damaged and it's below 600, that bank won't even look at it. So they might use it as a short-term vehicle just to park for a bit, 1 year, 3-year term, take it, fix up your credit. Maybe they might have a layoff just recently and they're going towards a medical leave or something. So it's just a short-term solution. That's why they do it for 3 years and 1 year. They don't want it to be there forever. They also want you to do well and move up in life and go to an A lender. It might be used as a short-term solution. That's why they give it for shorter period than bank. I know banks even have 10-year rates. People don't know.
Oh,
yeah, they have 10 years, 7 years, 5 years, 3 years, 2 years, 1 year.
Which banks?
Most of banks.
Oh, I was given only 5 years.
Yeah, 10 years, 7 years rates are a little higher than 5 years and 3 years. You don't get promotion much.
Okay.
But
people might not qualify either.
Yeah, it might be slightly higher because when people are going to A lending, they're always rate aggressive, right? They're very aggressive on the rate. So if they can get 4.09 versus 4.771, because sometimes 7 year and 10 years a little higher, so they will always say, okay, I can save $100, $200, like just the mentality. Yeah. So yeah.
And besides this lending, what is this funda about the second mortgage?
Second mortgage, people take it. Let's say I have clients who have, they need some funds, but it's probably they're getting it as a gift from family or something. Short-term period, they need to borrow funds because they have a home with an equity, but they cannot really, they don't want to really refinance and take money out to the traditional way. They will borrow so first mortgage will be with the bank or B bank or somebody. And then second, they will place it for a short-term period, like a 60,000, 100,000 to probably do some short-term business. Maybe they bought a house, they need to put an initial deposit, but they're about to sell this house, but it's not sold yet. They might temporarily borrow to, pay off some need that they might have. Instead of just, let's say if the market is suffering, like I have a client right now, the she needs a $60,000, $100,000 second mortgage to put a deposit on or finish off a deposit on a new built home.
Mhm.
But she knows she's going to sell this house. So when she sells this house, she will pay off the second mortgage and the first mortgage when this house is ready.
Mhm.
So
Now let's dive into some controversial topics.
yeah,
Like, see, I have seen
Yeah.
many cases, including myself,
Yeah.
where in the last minute, even though at the time of offer, we get the firm approval,
Yeah.
by the time we go to the closing, we get last minute surprises either from the financial institutions,
Yeah.
mostly from the financial institutions.
Yeah.
Hey, I think we cannot lend you now,
Uh-huh.
citing some XYZ reason.
Yeah.
But then, customers can't go anywhere.
Yeah.
Right?
Yeah.
So they can't go anywhere. Either the deal might fell through or
Yeah.
it might end up in legal dispute.
Yeah.
So, or to save time of everyone, they might go for some private lending
Yeah.
or some B lender, or they might ask for some extension of time.
Yeah.
So all these things happen, and I
Yeah.
see this happening quite frequently.
Yeah.
Like even with me, it happened almost like 3-4 times. Why these generally happen? Is it the fault at the customer side, or is it the fault at the financial institution side, or
It's a
the
combination of
liaising
many
between?
things, I would
Okay.
say. So like let's say like most of the B lenders, you submit a deal, they look at a deal. If they're happy, they send a commitment. Client signs the commitment, and the deal get instructed to the lawyer. But till then, they don't see the documents.
Mhm.
The documents are not verified yet. They are just giving you a commitment based on what you have submitted to them.
Yeah, it's a conditional.
Conditional. It's conditional, but as soon as you sign the commitment, the instruction goes to the lawyer.
Okay.
Then when the document verification team, when they look at the documents, they're like, okay, this was considered a legal basement. We gave you an approval based on that. Now they say this is not a legal basement. Client thinks it's legal because they bought the house with it. The basement was done, separate entrance. Clients don't know the terminologies, right? But then they ask for, okay, bring me the city's drawing for the certification that the basement is legal. Okay, there's no certificate. So I asked the client. Client says, "Oh, it was on MLS when we purchased it. It says fully finished basement, rented out with the previous owner. So they bought it based on that." So when it's probably like a misunderstanding on the
Okay.
language, and then that triggers, and then
Okay.
you can argue, escalate it.
Mhm.
But then if bank decided to, if they're not happy with the escalations, they can say, you know what, I'm so sorry. We were giving you money based on that. We don't want to continue anymore.
Mhm.
So last minute surprises can come with many lenders. I noticed with even on the broker side, as soon as you sign commitment letters, you sign that, instruction goes out, and then the documents get verified later.
Mhm.
So they might have disagreements on, and then they decided that they don't want to, but it shouldn't go to the last minute.
Mhm.
Most of the time, instructions, everything is done 10 days before. So you might have a 10 days before some idea. But appraisals during COVID time, we saw a lot. People bought without any conditions, no appraisal conditions, and there's a huge gap between what they bought it for, what's appraised for. They can't close because they cannot come up with the money. So a lot of things happen in the market that.
So who is at fault? Is it the customer? Because what the horror stories which I heard, I mean, I don't know if it is right or wrong, but many of the people say, oh, it was intentionally done by the realtor and the mortgage agent together. Some say the mortgage agent says that is your responsibility, not mine. And the realtor says it is not my headache. You both have to look at each
See,
other.
when things go wrong, if it ends well, everybody's happy. When things go wrong, everybody start pointing fingers, right? That's why, going back to my previous point, like when you before you buy a house, you have to sit with a mortgage professional. Doesn't matter who it is, at your own bank, through a broker, through an agent. You have to sit with them and see how much you can qualify, and you have to stick to that budget. And then you have to do the 5-day financial condition. Right now, I see a biggest mistake happening in the market. People bought pre-constructions. Most of the builder purchases says within 10 days of purchase, you have to have your finances in place. And a lot of builders do ask you pre-approval letters and all that. Sometimes situation changes, like, people might lose job with the market and everything by the time the house comes for closing. But most of the time, what I notice is people bought house and they're like, okay, I bought it in 2021, 2025, 2026 is the closing. Now, guess what happened? Market completely changed. Correct. Prices came down. It crashed, right? $200,000, $300,000 difference in the appraisal. People don't have $200,000, $300,000 sitting in their bank account. So, I know families are refinancing to help the person who purchased it to come up with a difference, but a lot of people are walking away. This could have been prevented had they done the firm approval of mortgages within 10 days of purchase. So right now, like I see a lot of clients have purchased like 1.5, appraisal come at 1.3. Even known areas like Oakville, where people think value always go up, it still got a big hit. It's all GTA and GTAH perhaps like got a big hit with the appraisal value. So this is something that we could have prevented had we done that actual homework, what they actually tell us to do within 10 days, because a lot of banks actually gives you an approval that's valid for till the closing. 3 years, 4 years, doesn't matter. As far as the closing date is set on the as per the purchase and sale agreement, you can have the approval valid till that date.
So don't they verify all the documentation at the time of disbursement?
As far as you
Because
don't
it's
have a
been like
material
3-4
change,
years.
you
Okay.
don't have a material change, you're fine.
Okay.
Yeah.
See, banks also have their own mortgage agents.
Yes.
Or like mortgage
Advisors. Agent specialists, they call
Okay.
different names. Yeah.
But why would anyone has to come to a mortgage agent
Yeah.
and not walk into the bank?
Yes. Both of them have good and bad. So I used to be a mortgage advisor with CIBC for like 10 years or so. I was a top performer. So I have done my part there. Now I have moved into a broker world, because when my clients came, when I was at the bank, I only had one option for them. Only one brand, one option. Now, I have over 10,000 clients. I have a big CRM. I have built my portfolio. So now I cannot keep rotating the client with the same place. I have to have options for my client. With the market changing, I needed to have options. So in 2023, when market was starting to change, I figured that I need to bargain on rates. And here there are so many lenders. I have small lenders who gives me very aggressive rates, and client wants that. They don't care where you borrow. At the end of the day, they just want to make the much lesser payment possible on their mortgage, right? So they can enjoy the other stuff in life. So why would you come to me? If you ask me as an agent, I have options for everything. I'm not a one-stop shop. I am a one-stop shop, but with 265 lenders. But before, I just have one lender, right?
Only CIBC.
Only CIBC. Now I have Scotia, TD, Manulife, like you name it, I have it. Ducar, like Altona Saving, A lender, B lender, C lender, like, and I have aggressive rates. So clients are happy. They can come to me, and if in case one person's credit score is bad, or they need to borrow money on the other house as a second mortgage, I have everything for them in one stop.
When I approached the mortgage agent,
Yeah,
I did not pay anything. But
Yeah.
then how does mortgage agents make money?
Oh, our lenders pay us.
Okay.
Yeah. So as soon as the file are like done, you send it for audit, they pay you within 2 to 3 days.
Oh, and now I get it. So
Yeah.
let's say if they give a cashback of some 2,000, 3,000
Banks give it to clients.
customers.
Yes.
So the same, I think.
No, for us, like you see how banks agent get paid. Like when they do a file, they get commission paid, right? Same thing when we do a file, that institution will pay us. If it's TD or Scotia or whoever, they will pay us for each file.
Now let's work out another option. Let's say same CIBC.
Yeah.
I'm a CIBC customer.
Yeah.
So I approached you.
Yeah.
Mortgage agent,
Yeah.
like a mortgage agent, not as a CIBC advisor, but as a mortgage agent.
On the mortgage, on our channel, on our agent side,
Yes,
we only have TD Scotia.
Let's say.
We don't have RBC and CIBC.
Yeah. Let's say CIBC is there.
Yeah.
I'm also a big customer of CIBC.
Yeah.
So will I still get the cashback even if I get the mortgage from CIBC through the agent?
So our channel don't have CIBC.
Okay.
CIBC is not on the broker channel.
Okay. Let's say Scotia.
Scotia, yes. So Scotia doesn't have a cash incentive program. So mostly they offer, depending on your credit score and income, they offer line of credit at that time. Most clients I have seen, they get a nice line of credit, but they don't have a cash incentive program at this time. So promotion varies for bank to bank.
Okay.
So at this time, Scotia doesn't have cash, but the TD has it. TD has cash incentive. BMO has cash incentive going on. Only Scotia is not doing at this time, but CIBC.
So they pay the mortgage agent and also the customer.
So the mortgage agent for their work, customer as a thank you, for thank you. There are some clauses. Actually, you have to pay the mortgage payment through their bank account. You have to open up a bank account. If you don't have, it's like TD for sure. For example, if you don't have a TD account, you have to open up a TD bank account and pay the mortgage from the TD account. Then you qualify for the cash incentive. It's an incentive they do for things for banking.
Kind of cross-selling as well. Because you have dealt with almost all the banks. Yeah. If you were to ask me to tell blindly, like getting mortgage in which bank is relatively easier? For a very normal customer.
Yeah, for a normal customer.
Normal salaried customer.
Yeah.
Which bank is?
See, I love dealing with TD Bank.
Okay.
Customer comes, you submit, they're very quick. Their underwriting is like within 48 hours, you get a
Mhm.
commitment. Clients are happy because they are hearing from you within 48 hours with the commitment letter. And as soon as you sign the commitment, lawyer gets instruction, because once they get to know your lawyer's information, lawyers get the instructions. And then you just work towards the fulfilling the conditions. They're easy, and they also, TD Bank is very easy to deal with too. They have
Mhm.
tellers, even for new immigrants. It's very user friendly. If you need to download their statements, it's a very user friendly platform too. They
Mhm.
have made their app very user friendly. Their online banking is very user friendly. So I would say I personally like dealing with them.
Which B lender would you say easier one to?
Yeah, B lender. From my experience, I really like dealing with Home Trust.
Mhm.
They're also, again, like very, underwriters are very approachable. You can call them, email them. Their information is readily available. As soon as you submit a deal, it will come up who's your BDM, who's your underwriter, who's the document fulfillment. They have their phone numbers available, their email address are available. You can talk to them through a portal. Very user friendly platform. They have it too in the system. They're one of the best, I would say.
And I came across one advice from one of the realtor.
Yeah.
Not realtor, even mortgage agent. I
Yeah.
think like sometimes go with this lender, it won't reflect in your credit report. But if you go with this lender, it will reflect in this credit report. So is that still valid these days? I mean, this has been.
I mean,
a
everybody
discussion.
has to report. Like we have to
Okay.
be honest and open about it. But everybody would report on the credit report. Sometimes it just may be error, or I know some lenders don't show up. But then obviously, when you put an application, you have to let the person know that which lender where you have the mortgages, right? Like,
No, it did not show up for me. I
yeah,
think two of the lenders,
yeah,
B lenders,
it didn't come
from
up on the
whom it
credit
did not
bureau.
come up on the. So
Some lenders have sometimes glitch or
okay, might be like it was like 4 or 5 years back,
okay,
but I don't know what is the situation now.
okay.
But if that is really happening, then it can be a good hack to invest in more property.
No, I mean, every client have an option. Like, you have options, so
Yeah.
yeah, you can be upfront about it.
Mhm.
Yeah.
And another thing which I observed in my case itself,
Yeah.
like if I am purchasing the property
Yeah.
on my corporation,
Yeah.
it doesn't reflect in my credit report.
Okay, so because that liability is owned by the corporation,
Okay.
not by you.
Mhm.
So yeah, I have seen. So if you buy a property and you wanted to register the property under the corporation name, if you pull the corporation name, it will show up. If you pull the corporation's like under purview, it will show up all the property the corporation own.
Mhm.
It's not coming up on your personal because you don't own it. But when the bank qualifies you, they use your income. So a lot of people buy rental properties, for example, they buy it under corporation name because they want to build a rental portfolio. That some people take that even as a job. They manage their own properties, right? Property management. So what they do is they register the property under the holding corp. And you can do that, but they use your personal income to qualify, but then they register the property under the whole corp. Like even people say, like, if generally there's a common thing people say, if somebody come to sue you, it's they're suing your corporation, not your personal assets. So a lot of people do that, especially for, I have seen it a lot with the rental property, but not really owner occupied. But I think it's also a very good practice. Some accountants advise that you register the rental properties and keep them separate from your personal, if you're going to do a property management type of idea in the future.
So what is the process for that? Like if today I have to buy a property through the corporation,
Right.
okay, is the process going to be the same or
Very
different?
similar. It's just the registration is going to happen under your whole code.
Okay, so the entire qualification is on the personal
Everything.
names.
Yes. Your if your salary, pay stub, T4, employment letter. But if you're self-employed, your NOA,
So
T1,
maybe
T2.
like a week before closing, we just have to open the corporation, add the required people, and then send those information to the
Yeah,
lawyer.
don't do it a week before. Then that's where the hiccups comes.
Okay.
Do it like, if you're planning to buy a property under the whole co, just open up one, or if you have an existing one, you can use that, and you can send it down so that they know. So when we submit a file to a lender, we have to be upfront about everything that they know, right? So it's better to tell them, okay, client's plan is to register the property under the corporation name or the personal name. If you put that in the loan notes upfront about everything, then there won't be any hiccups, no surprises. They're not having any surprises. They're not giving you any surprises. So it's better to say the plan upfront, unless some people down the we're working on a file and they say in the middle, what, I forgot to tell you, I just went to see my accountant, he suggested we should do it under corporation. As soon as we know the information, we have to let the lender know.
Okay.
Yeah, transparent is pretty important here.